Good morning, traders. Welcome to the Tuesday, May the 31st, Bull versus Bear webinar. James Thorpe today, stepping in for Steve Miley on a beautiful Tuesday morning here in Chicago. It's about 74 degrees Fahrenheit outside. For our European friends, go work it out yourself what that is in Celsius. I can't remember how to do the calculation off the top of my head, despite coming from that part of the world. But welcome, welcome, welcome. We are back from a long weekend, the Memorial Day weekend. I hope our US traders enjoyed the long weekend, and the markets should be sort of back to normal now with their normal opening and closing times. Which leads me actually into one of the first things I want to start the meeting with this morning, and that is a note on closing at weekends. Okay, so let's just put aside the federal holiday. That's what we call them in the United States, bank holidays in the UK. I don't know what you call them in your part of the world, but let's just put aside the Memorial Day weekend for a moment and just talk about regular weekends. Now, we have a lot of new people coming onto the platform, and sometimes I see people sign up the weekend and then very quickly sign the market data agreement, which is the first indication that they're going through to the trading platform on the weekends, and then I pretty much know what comes next. They try and enter a few orders in the market and they get rejected. And I just want to sort of explain that for our new traders on the platform. So our experienced traders, please bear with me for a moment. To our new traders, futures markets aren't open 24 hours like, for example, crypto markets or some CFD products based off foreign exchange. Futures markets are closed for the weekends and indeed close during the week. Now, most futures markets that we trade on the CME close for just 1 hour during the week. 4 p.m. usually Chicago time for 1 hour until 5 p.m. and then they reopen and resume their trading. Or it's actually what we call a brand new trading session at 5 p.m. and it goes through to the next day at 4 p.m. But at 4 p.m. on Fridays, the markets close for the weekends. Now, we have a section on our website here under trader education. So if you hit the drop down menu, quick trader quick tips. And here we just try and answer in sort of 3 to 5 minute videos some of our most frequently asked questions. The first three are more to do with Trade Day as a members site, but moving down, we can see a section on trading futures, how to find the correct listed month to trade. So remember, we're looking for the most actively traded month in the product that we want to trade. Right now, most of you are trading stock indexes. The most active trading month is June, but that is about to roll. We'll cover that in future webinars. But what we also want to know is when the market closes. So we've got a 4-minute video here on when the market closes. It's scrolling down further, some quick lessons on how to use the Tradeovate platform, particularly around placing orders in the market. But here you'll find a short video on when the market closes and a link to the CME Group trading hours. Now, if you want more details, you can go over to our free courses section. And in our free courses section here, getting ready to trade, this really covers the meat and bones of futures contracts. And a look at contract specifications here talks about, amongst other things, the closing times of futures contracts. So if you're brand new to futures, head over to there, work through our courses. If you just need a quick refresher, head to our quick trader tips section, and you'll avoid, one, trying to place orders in the market when it's closing, and two, running the danger of carrying an open position into the market closing. Now, that segues nicely into our next Next thing I want to touch on quickly, and that's a note about holiday markets. Okay, so we had the Memorial Day weekend, and that's what we call a federal holiday here in the United States. And what tends to happen is that the markets close. In some cases, what we have are cash markets close, which the futures markets are based off of. But the futures markets might remain open, certainly for a short period of time. And that's what we had yesterday. So the markets opened like normal on Sunday at 5 p.m. Chicago time, but there's a lot of early closing yesterday in the markets. Certainly, the equity markets closed at 12 p.m. instead of 4 p.m. Chicago time before reopening at 5 p.m. on Monday. Now, what I want to talk about actually, and I want to circle right back to this at the end of the lesson when we cover James's thought for the day, which I know you're all really excited to hear about. But what I just want to cover quickly is that holiday markets, and again, this is really for our new traders. I apologize if you're an experienced trader and you know all this, but we do have a lot of new people on the platform, and we try to use these morning meetings as a way of imparting our experience and our knowledge and helping educate our traders. The holiday markets, what we call holiday markets or early closing markets, what we tend to see here is because the cash markets are closed, generally the futures markets will be quiet. Now, in trading, we never deal in absolutes. We know that, right? But we can deal in generalizations. It's not always the case, but what I'm saying is generally the markets can be closed because of the lack of interest in the markets and the lack of direction of the futures markets being driven by the underlying cash markets that are closed. So yesterday we had a situation where the cash markets were closed, but the futures markets were open for a short period of time, and it can generally lead to a lack of interest. The other thing that it can lead to is a lack of liquidity. Right, so a lot of people, not a lot of people, but one of the big strategies that helps create liquidity in a market is what we call a market making strategy. And the market making, the people that do market making tend to make markets high frequency, low latency trading shops that are making markets in let's say cash. In futures equity contracts against what's happening in the cash, right? So if there's nothing happening in the cash, or their reference price for quoting the market in the futures is not available, then they're not going to quote in the futures, right? So we see a reduced lack of liquidity. So it's lack of interest, traders off, just enjoying the long weekend with their families and friends. And the reference price for market making are closed. The cash markets are closed. So what we tend to see is not just a lack of interest, but we can now start to see a reduced liquidity in the market. And that's important because markets can still move. But when they move, they can move hard and fast. So it's kind of like you get stuck in this dichotomy where the markets can either be really quiet and not doing much. Of course, when they move, they could just move normally, but sometimes when they move, they can move hard and fast, and the move can be unexpected and difficult to trade because of the reduced liquidity. And that can also equal or lead to stops being run. So you might have a stop in. Remember, when that price is hit, your order is triggered and it becomes a market order, which basically, if you're long and you have a sell stop in, as soon as that price prints, it becomes a market order, and that market order is to sell the next best available bid, not the price that you put the order in. So if you've put the price in, sell one at 25 on stop, as soon as 25 trades, it's going to try and sell one at 25. But if the next best bid's 24, it's going to sell one at 24. Or if the next best bid is 23, it's going to sell one at 23. Now, what happens if somebody sells 1,000 S&Ps at market and they sell them at 20, the first price is 25, they're going to take out the 25s, they're going to take out the 24s, take out the 23s, 22s, and then, you're going to be hitting sort of 21s and 20s. So you're going to see a lot of slippage in the, I'm just using those prices as examples. You could see a lot of slippage in your orders. All right. So just be very careful on holiday markets. We don't recommend trading them. We recommend enjoying some time off with your family, resting yourself, and then coming back, the next day. And I'll circle back to that as well at the end of the meeting because I've got something, a thought for the day that ties in with that. Right, where are we? 6:40, 10 minutes in, and we haven't even started the meeting proper. Here we go. Right, for the let's start off with a look at the data. So we have the daily calendar that we normally run through, but it's effectively Monday. I know it's Tuesday, but it's the first meeting of the week. So I just want to line up what's coming out for the rest of the week. This link here opens the CME's daily economic calendar. We can actually see here, we can pull up the calendar for the tomorrow in the week. But if we hit this, we open up this, which is the CME's market calendar. And what I've actually done is I hit next month to take us into June because today is the last day of May, Tuesday, May the 31st. And I'll look at today's data in a moment, but just wanted a quick look at the week ahead to see what's coming up, what we can prepare for. And of course, the big thing this week is the non-farm payroll on Friday. Now, normally we get the head of the non-farm payroll, we get the US ADP number on Wednesday. That's been bumped to Thursday because of the federal holiday, so that will coincide with the weekly jobless claims. That may or may not give us some indication of what we're likely to see on Friday. But in terms of US data this week, that's the big number that we're focusing on. We can see sort of like later on in the week, we've got some PMI data coming out and some ISM, which is, I think we've got manufacturing and non-manufacturing. Let's have a look. Got some construction spending out the US later in the week. US ISM manufacturing index. If you click on these links and they give you the full details. So the ISM index is expected to slow further in May to 54.5 after April's 1.7 point decline to 55.4 that missed economy's consensus's range. Look at their economies. So a little definition of it, you can see Institute for Supply Management. It's a diffusion index calculated from 5 of the 11 subcomponents of a monthly survey of purchasing managers at roughly 300 manufacturing firms. So it's a survey, tends to, not tends to, if it's above 50, it's showing growth. And if it's below 50, it's showing contraction. But what we're actually expecting to see is a small drop off from where it was, to show slow further growth. Let's just close that down for a second. So that's kind of what's on the calendar. Really, the focus for Friday is non-farm payroll. Right, let's bring it back to today and see what's going on. We've had quite a bit of data out of Europe. As you can see here, we actually don't have much on the calendar for the United States that's really going to impact us, I don't think. Consumer confidence at 10 a.m. New York time, which is 11 p.m. Chicago time. So that's probably the biggest thing. But just running through the data this morning in Europe, we've had some GDP coming out. Actually, why don't we do this? I just want to look at yesterday's data. Yesterday evening, and the reason is we had some Chinese data out last night, manufacturing PMI and Chinese composite PMI, and we can see slightly better than expected, but again below this crucial 50 number, which again above 50 shows growth, below 50 shows contraction, but better than expected numbers. Okay, and the reason why I point that out is because yesterday's markets got a bid on more positivity coming out of China. It's largely around the easings of the lockdown curbs, particularly in Shanghai, but on other regions and cities and provinces in China. The zero COVID policy. Those lockdowns and restrictions are being curbed and easing. And I think from Wednesday this week, Shanghai residents can get out and start driving, get out their apartments. So, yeah, the market got a nice bid from that yesterday. And, what we can see here is that although manufacturing is still slowing and contracting in China, which, leads us to worry about ultimately Chinese growth overall and GDP, we can still see it's slightly positive. And that was like late last night. Going into today, just looking through this, we had some Swiss numbers, but Swiss is such a small economy, it doesn't really affect us. The most important really is the Eurozone here and the Eurozone here. These are the French numbers. They marked it as Euro, but it's actually French numbers, the tricolor. French consumer spending, miss, CPI, CPI is hotter. All right, now we've seen this is important. Remember, the CPI numbers, the inflation data, or any data around inflation is potentially the biggest focus at the moment, bigger than GDP, bigger than payrolls. We are hyper focused on inflation, and our stock markets, we'll look at the charts in a minute, put in some bases because we thought that we were getting ahead of ourselves in terms of the worry on inflation, and the sell-off had been overdone. And we put in some bases a few days ago. Good, big shout out to Steve, our technical analysis, Steve Marley, my partner. The market chart is calling the bottoms there and putting those bases in. But what we're seeing here is actually CPI running a little hotter than expected in Europe. That's not good. GDP missing. Well, we kind of expect GDP to be slower and slowing down. Again, that's not so good that it's missing, but it's kind of expected. What else have we got here? Eurozone unemployment miss in line. I said Germany, I beg your pardon, Germany unemployment missing in line. Bank of England. Nothing really important there. See this? All tier one, right? So if you've got one horn here, it means it's it's not tier one. It's like a minor data release. Tier one, the most important is the three horns, right? Into the Eurozone. Let's have a look at the Eurozone here. Core CPI, a little hotter. Yeah, mixed. Here we go. Year on year, 8.1%. This is not good, right? This means inflation's getting to be a problem in Europe. Now, there's always been a bit of a lag, it seems, in the last few months with inflation data coming out of Europe. So it's is it that surprising? I don't know. The feeling was, we shouldn't be so worried about inflation in Europe. We haven't had, the massive sort of monetary stimulus that the United States had in response to COVID. But this goes to show, really, this inflation's been driven by high energy prices and supply chain issues. And what we're seeing here is a hot number, and this is not going to be good for the day ahead. Talking of the day ahead, some Canadian numbers, no big deal for us. These are the United States data. As I said, we've got the consumer confidence at 10 a.m. New York time. Some house price index data. Not a lot in here, to be honest. And then, nothing, not much. Got some manufacturing PMI out of China, some Korean data. These, I might see if I can take these off the calendar. They're not really going to impact us. So what we're seeing, really what's going to drive prices today is the momentum out of Europe, I think, this morning, which, probably is reacting to this hot inflation data. So let's move down what we have in terms of headlines. Okay, so we touched on China earlier. Decline in China's factory activity slows as COVID curbs ease. Okay, Beijing, China's factory activity fell at a slower pace in May. Okay, so that's what we looked at. It's still contracting, but it fell at a slower pace. Official manufacturing purchasing managers index rose to 49.6 in May from 47.4. China's factory slowdown is affecting production. Well, no shit, Sherlock. And other major Asian economies in the region. While the PMI is at a 3-month high, it remains below the 50-point mark. Okay, so I still think that's a little positive out of China. I don't, if anything would have happened, that would have impacted our markets overnight. I don't think we can really sort of bring any sort of momentum into the day from that. Let's have a look at this headline here. This one is French inflation hits new record high. Okay, so this is good because this is going to touch on, what I think is going to set the tone for the day here in the markets at the end of the month. French inflation rose more than expected in May to a new record. Preliminary EU harmonised data showed on Friday, putting pressure on President Emmanuel Macron ahead of legislative elections this month. Okay, tackling high inflation is a top of France's political agenda. It's the same in all the countries. In fact, on that note, Biden and Powell are meeting today. Now, this is kind of unusual because you remember the Federal Reserve is independent, it's apolitical, but the high inflation in this country, which is becomes a political issue. It creates not civil unrest. That's the wrong word, but the population in America aren't happy. Certainly the prices that you notice here, particularly, are at the gas station. I drove all the way up to Minocqua, which is about a 6-hour drive last week, and I had to fill the car up twice. Like, wow, it's expensive. But I know my European friends are like, well, you should see the price of gas, or petrol as we call it in the UK. It's it's considerably more because there's so much more tax built into it. But that's where you kind of that's one of the first things that people see and talk about here is the price of gas at the pump. It's running high. Powell's meeting with Biden today. I think they're just going to be talking about obviously focusing on inflation, but what is the way forward? And I think we might see some more hawkish comments, which is going to erode some of our gains in the United States. But I don't think we'll see anything out of that meeting in particular. But let's just keep an eye on what Fed speakers are saying in the next few weeks to see if the markets have it right, or they're trying to prepare the markets for more hawkish outlook. Right, so that's the French inflation. The big story as well at the moment is oil. So we actually don't have many traders trading oil at the moment. We had a few months back, but not so many at the moment. But the oil is extending its bull run. Now, the big thing here is sanctions against Russia. And there has been some debate on what these sanctions should look like, but finally, the European Union has agreed to ban all oil imports from Russia that come by sea and restrict some of the oil imports that come by pipeline. So there's been some sanctions made, particularly, I think, to Hungary, which relies on all its oil from Russia via its pipeline. So that's going to be allowed to continue. But we've also seen, I think, some of the European countries that get their oil, some of their oil from Russia via pipeline, talk about weaning themselves off the need to get that oil by the end of the year. So let's have a look. Oil prices extend a bull run on Tuesday after EU agreed to a partial ban on Russian oil, and obviously China decided to lift some curbs. So we're going to see more demand of oil there. So Brent crude for July rose $2.31 a barrel to 123. West Texas Intermediary, which is the contract that we trade on the CME, is $119 a barrel, up 4.27 in a fourth session of gains in a row, or 3.7% from Friday's close. European Union leaders agreed in principle to cut 90% of oil imports from Russia by the end of 2022, the bloc's toughest sanction yet on Moscow since the invasion of Ukraine. The embargo exempts pipeline oil from Russia as a concession to Hungary. As 2/3 of Russian oil exports are seaborne, around 1.5 million barrels per day of oil will need to be replaced by the EU. This volume is actually closer to 2.1 to 2.2 million barrels per day, as both Poland and Germany are planning to phase out pipeline purchases by the end of the year. That's what's driving oil. Hard to see, even though oil, we'll have a look at the chart in a minute, is sitting up at those highs and it looks like it's overdone. It's hard to really see any significant pullback in oil while we're having these sort of headlines. What's this headline here? Finally, morning bid fever pitch. Okay, this is just a quick summary. Let's read through this. Look at the day ahead in the markets. Perhaps it's fitting that a month that has seen such a remarkable swing in interest rate expectations for the major economies is ending on the same note that kicked this off: soaring price pressure. Germany consumer prices rose by a whopping 8.7%, and Spanish inflation rates resumed their upward march, setting the stage for another record Eurozone aggregate inflation data for May, with Reuters poll expecting a print of 7.7%. That has decisively turned the mood music in favor of a bears. US Treasury yields rose 10 basis points in Asian trading. Hawkish remarks from US federal governor Christopher Walker also dashed expectations. Okay, so I didn't know this. This is interesting. Christopher Walker, he's a voting member of the FOMC. So you have members of the Fed who actually don't set interest rates but have a say. Christopher Walker is a voting member, and he's putting European and US stock futures on a course for a rocky start to the final session of the month, which has seen world equities shed 4 trillion before recouping all of their losses. Crucially, here we are. Waller, sorry, not Waller, not Walker. Waller, what am I thinking? Crucially, Waller's comments came before a meeting on Tuesday between Fed Chair Powell and US President Joe Biden, which we've just discussed. Right. Yeah. So Waller's basically said, doesn't say here what he said, but he's been more hawkish on rates. Yeah, I can't see anything that he said there. Right. I can't see exactly what he's said, but he's clearly said something that's like, hey, we're not going to ease up the pressure on hiking rates while we focus to try and get inflation under control. That's what I think is going to drive price today. Um, so look at the headlines from Forex Live. They're all the same. Powell and Biden. Money markets increase bets on ECB rate hike after inflation data. Yeah. Okay, let's get over to the charts and get this meeting sort of wrapped up in the next 10 minutes. Start with the E-mini for June. Okay, so put a top in here. Look at that level of resistance that it failed at. Let's see where that goes back to. Oh, okay, so this low here. So it's hit that, putting a level of resistance, and in the morning session, it started to fade. We can see that here, yeah. But let's put a look now. Already putting in a small downtrend. Okay, so my feeling is today we're going to have a lackluster day in the markets. It's going to drift. It's hard to see a reason why we will break this level of resistance here and head through this high that's already been established. I think the high on the day has been established. That's that's yesterday's high. That was buoyed by the news out of China that we had the lockdowns easing in China, but we've also had, remember, some slightly positive but still below growth PMI data, and that's been priced in. I think we're just going to hold this sort of downtrend and sort of drift towards this uptrend today. I think it's not going to go any lower than here, 4040 and higher. I don't think it's going to break above 4200 in the S&Ps. So I think we're kind of stuck in a range, unfortunately, now for the rest of the day. Lackluster trading is going to drift. I'll finish up on my thought for the day soon, which will tie into this nicely. Nasdaq is likely to be a very similar story. Yeah, so kind of drifting down here. I wonder if we can put a line in here, horizontal line here. You see, and I think this is where we might hold sort of around here today. If we do break, you're looking to sort of get down to these levels here, but very difficult to see. Of course, unless there's some breaking news that comes out during the day, it's very difficult to see or justify a reason why prices should break above yesterday's high. Particularly with the hot inflation data out of Europe. We're trading US markets. I understand that. But inflation is a global issue at the moment. And if there's no sign of it slowing, in Europe, it might be a little bit lead lag, right? Okay, so it's not all doom and gloom, but it's the end of the month. Last day of the month, might we see some profit taking from the last week of rallies, book squaring, lackluster trading. I can't really see it moving higher today. Let's have a quick look at oil. Oil is a crazy bid. See, up here, the natural instinct is, well, it's way overdone, let's sell it. But really, there is no bearish news out at the moment. It'd be very difficult to justify taking a short here. If you're taking a short here, just based on what a chart looks like, you're just doing it because it looks that it's overdone. But that doesn't look overdone if in the next 3 days it prints up here up to 130. That everyone will be like, oh, look, that was a great buy because it broke this level of resistance here. So, be careful about shorting oil. Very, very difficult market to trade right now. Traded beautifully technically, and hit these sort of like lovely sort of uptrends lines and previously, but right now, very difficult market to trade. I think I'm going to leave it there on the charts. Steve's our in-house chart expert. He's back tomorrow. He can talk you more through the charts. My strength really is in trading and trading psychology and market psychology. On that note, I would like to leave you with one thought for the day. And what I want you to do is think about this in your trading. You really need to be less proactive and more reactive in your trading. Now, what do I mean by that? Well, you need to ask yourself, what is the market giving me today? What is the market telling me? What is the market trying to do? Rather than trying to imprint on the market what it is you want out of it. And, this ties in really to the sort of the quiet markets yesterday and the difficult trading decisions. As I said, I'll loop back to it at the beginning of today's meeting. Coming into yesterday, the short trading session that we, kind of expected to be kind of tricky. What we see is like amongst some of our traders, less experienced traders, is this, they're driven by this belief that they need to make X amount every day. And I get that. It comes from, I think, being a day trader. Right, you have this inherent, whether you acknowledge it or not, but somewhere in your psychology, you have this inherent need to try and make money every day, and I get that. And when you're on the evaluation challenge, perhaps that's even reinforced a little bit more from the monthly membership, because you join, you're like, oh, I'll see if I can make the profit target in 15 days. I can probably do that within 1 month. It's $1,500 if I'm on the beginner. What's $1,500 in 15 days? Divide that. And, you're thinking, well, if I can make sort of $200-300 a day, and then you sort of have a losing day and then you scratch a couple of days and all of a sudden your profit target grows. And now I've got to make sort of $300-400 a day. And all of a sudden, what you're trying to do is just take money out of the market, regardless of what's going on in the market. And it's very difficult to sort of, as a day trader, to objectively step back and sort of say, okay, what's available in terms of opportunity in the market today? What's the market trying to do today? What's the market telling me today? Is it a good day to trade? Is it a bad day to trade? Or you've traded a couple of times and you've kind of like, you haven't really got anywhere. Perhaps the day is done for you. Perhaps you don't trade today, or if you've traded, you've lost a little bit. Perhaps it's just time to sort of stop and walk away. Instead of rather like, I've got to make $500 today, so I'm going to go at it and trade all day until I make $500. Right? You see what you're doing there? You're trying to imprint and push onto the market what you want out of the market. And that's not how trading works. The market will occasionally give you opportunity. That's really good. It will occasionally be very difficult to trade. Occasionally, you will be out of sync with the market for whatever reason. Your headspace is somewhere else. You're focusing on something else. You're under pressure, or whatever it might be. You're not in the right frame of mind to make good, impartial trading decisions. So you shouldn't be trading those days. And in the days that you are ready, doesn't mean the market's ready to give you money. Right? You've got to be really careful about this sort of like need or feel to try and make money every day. It just doesn't happen. And your approach should be much more reactive to the market rather than proactive, trying to force your P&L onto the market and out of the market. Be much more reactive. Is it a good opportunity today? Is this the type of market that I like to trade that yields good opportunity for me? In which case, I shall trade it until the market's given me what it's going to give me. All right. Think about that as you approach your trading this week. It could be a lackluster day. Let's see what's going on. Let's quickly go back to the e-mini, see if anything's happened. It could be a lackluster day today. It could be a difficult day to trade. It's not going to be the greatest opportunities in the market. So don't look for those big wins today. All right. On that note, I'm going to leave it. Have a great trading day, traders. Steve Miley's back tomorrow. I'll probably be around some point, if not this week, early next week, to cover him. I look forward to speaking to you then. Good luck.